September 15th, 2008. A Monday morning in Manhattan. Bankers in sharp suits rushed into glass towers, clutching coffees, scrolling through their BlackBerries. On the surface, it looked like just another busy day on Wall Street. But behind closed doors, panic had set in. Lehman Brothers, a bank older than the light bulb, with more than $600 billion in assets, had filed for bankruptcy. It was the largest in American history. In an instant, decades of trust in the global financial system evaporated. The collapse wasn't just about numbers or balance sheets. It was a story of greed, overconfidence, and the illusion that the good times would never end. And here's the truth. Even today, in 2025, we are still living with the aftershocks. From mortgage rates in Canada, to housing affordability in Australia, to inflation in the UK, and Wall Street's volatility in the US, the fingerprints of 2008 are everywhere. In this Money Stories deep dive, we'll travel back in time to uncover what really caused the global financial crisis, why it spread so far, and why its echoes still shape every decision made in global markets today. The seeds of the crisis were planted years earlier. After the dot-com crash of 2000 and the shock of 9/11, the US economy needed a boost. The Federal Reserve slashed interest rates to historic lows. Borrowing money became cheap, too cheap. Families who once couldn't dream of owning a home suddenly could. Banks encouraged it. Mortgage brokers promised deals with little or no down payments, and Wall Street was eager to profit. Enter the world of subprime mortgages, loans designed for people with poor credit, unstable income, or no. Proof of assets. Risky? Yes. But there was a catch. The risk didn't stay with the banks. Instead, loans were bundled together into financial products called mortgage-backed securities. These were then sold to investors. Pension funds in Canada, hedge funds in London, even banks in Australia. Because the loans were grouped, they seemed safe, almost bulletproof. Credit rating agencies slapped them with AA ratings, the gold standard. On paper, it looked like genius. Banks made money on fees. Investors enjoyed high returns. Politicians cheered rising home ownership, and everyday families moved into homes they couldn't actually afford. But behind the scenes, it was a house of cards. Because if enough people defaulted, the whole structure would collapse. By 2006, cracks began to appear. Housing prices, which had soared for years, started to stall. Suddenly, people who bought homes with little money down owed more than their houses were worth. They couldn't refinance. They couldn't sell. And when mortgage payments adjusted upward, defaults skyrocketed. Yet Wall Street didn't stop. Why? Because the profits were too good. Investment banks like Lehman Brothers, Bear Stearns, and Merrill Lynch were leveraged to the hilt, borrowing $30 or even $40 for every single dollar they actually owned. Even insiders sounded alarms. In 2005, economist Robert Shiller warned that the housing market was a bubble. In 2006, some hedge fund managers began betting against mortgage bonds, convinced disaster was coming, but their voices were drowned out by the chorus of optimism. The culture of Wall Street thrived on risk, and risk was everywhere. Then came 2007. First, small lenders began folding. Then, in March 2008, Bear Stearns collapsed, sold for pennies to JP Morgan Chase in a government-backed rescue. Confidence began to shake. But the real earthquake struck on September 15, 2008. Lehman Brothers, after 158 years in business, was allowed to fail. The bankruptcy sent shockwaves across the globe. The Dow Jones plunged 500 points in a single day. Credit markets froze. Banks refused to lend to one another, and it spread far beyond America. In the UK, Northern Rock had already collapsed the year before, leading to the first run on a British bank in more than a century. In Canada, exports dried up, factories closed, and pension funds tied to Wall Street stumbled. In Australia, commodity prices fell off a cliff as China's demand slowed. The global economy was unraveling, link by link. Statistics tell one part of the story, but behind those numbers were people. In the United States, more than 8 million jobs were lost. Unemployment shot to 10%. Families lost 6 million homes to foreclosure. Retirement accounts shrank overnight. For millennials, just starting their adult lives, The crisis was a brutal initiation into the workforce. In the UK, austerity policies cut deep, reshaping politics for a generation. In Canada, the dream of stable housing grew harder as the market tightened. In Australia, households saw wealth erased, and young people found themselves priced out as the recovery distorted housing affordability. The crash wasn't just economic. It was social, political, and generational. Governments had to act. The US launched TARP, a $700 billion bailout for banks and automakers. The Federal Reserve slashed rates to zero and invented new tools, quantitative easing, pumping trillions into the system. The Bank of England, the European Central Bank, the Bank of Canada, the Reserve Bank of Australia, all followed with their own rescue plans. Trillions were created, spent, or guaranteed. But this response sparked debate. Critics asked, why rescue the banks that caused the mess? Why not rescue homeowners directly? The anger fed political movements. Occupy Wall Street, the Tea Party, Brexit campaigns, and later, populist leaders around the world. Now let's connect the dots to 2025. The 2008 crisis changed everything. Number 1, banking regulation. New rules like Dodd-Frank in the US and Basel III globally forced banks to hold more capital, disclose risks, and face stricter oversight. Number 2, central bank power. Institutions like the Fed, the Bank of England, and the Reserve Bank of Australia now act faster and with greater force. During the pandemic of 2020, they unleashed trillions within weeks, a playbook learned from 2008. Number 3, market psychology. Every downturn since, whether Europe's debt crisis, the COVID crash, or today's inflation battles, is measured against 2008. The fear lingers. Investors remember. Number 4, housing today. Ironically, attempts to stabilize housing, markets back then made homes even more expensive now. Low interest rates fueled new bubbles in Canada, Australia, and even parts of the US. Number 5, political fallout. Polarization, distrust of elites, the rise of populism. Many of today's political divides trace back to the anger of 2008. The 2008 financial crisis wasn't just a moment in history. It was a turning point, a story of greed, hubris, and human cost. A reminder that markets are not machines. They are stories woven from the hopes, fears, and mistakes of millions. And in 2025, when you see headlines about inflation, interest, rates, or stock market crashes, remember, the shadow of 2008 still looms. This was Money Stories. If you found this deep dive valuable, subscribe for more. Because behind every number is a story, and we'll keep telling them.